If you gave me a completely empty ISA today, £0, and told me I had to build a portfolio for 2026 from scratch, here is exactly what I'd do. Step by step, no get-rich-quick fluff, just the actual, boring, reliable blueprint. Most people fail at investing not because they pick the wrong stocks, but because they never build a system. In 2026, the landscape has shifted, inflation is stubborn, AI is changing industries, and interest rates are a new game. Yet, millions are still using a playbook written for an economy that died 5 years ago. Stick with me, because at minute 9, I'm going to reveal the math of compound growth that most people ignore, and it's costing them thousands. Let's get into the blueprint. Before you invest a single pound, you need stability. I follow a strict hierarchy. First, your emergency fund, 3 to 6 months of expenses. Why? Because the worst time to sell investments is when the market crashes. If you lose your job and you're forced to sell your stocks to pay rent, your wealth-building journey ends. Second, wipe out high-interest debt. If you're paying 24% on a credit card, no index fund in the world will save you. You must clear the path before you start the race. This is the foundation. Without it, you aren't investing. You're gambling with a net underneath you that's full of holes. Now, if you're in the UK, here is the biggest mistake I see. People open random brokerage accounts before maxing out their stocks and shares. ISA. An ISA isn't just an account, it's a legal tax shield. Every pound of growth and every dividend inside an ISA is shielded from capital gains and dividend tax. You get an annual allowance resetting every April 6th. If you aren't using this wrapper, you are voluntarily giving a cut of your wealth to the taxman. My blueprint always starts here. If you have any allowance left, that is where your first pound must go. Okay, what do you actually buy? People expect me to say, the next big tech stock. I'm going to disappoint you. I keep it boring. The core of my portfolio is a globally diversified, low-cost index fund. Why? Because I don't want to bet on one company, one country, or one sector. I want to own the global economy, whether AI booms or a specific industry flops. If the global economy grows, I grow. I target 70 to 80% in a global all-cap index, a small tilt toward S&P 500 for that extra growth, and if I'm closer to my goal, some ballast in bonds. Simple, diversified, long-term. This isn't about guessing the winner. It's about owning the entire field. The smartest investors aren't the ones with the highest IQs. They're the ones with the best automation. I set up a direct debit for my payday. The moment my salary lands, the investment moves out. It's called pound cost averaging. When the market is high, I buy fewer units. When it crashes, I buy more units at a discount. By automating it, I remove the biggest enemy of wealth, my own emotions. I'm not asking, is today a good day to buy? I'm just buying. Consistency beats perfection every single time. Here is what nobody tells you. Fees. You see a 1% fee and think it's nothing. But over 20 years, that 1% compounds against you, eating a massive chunk of your total growth. Always check the OCF, the ongoing charges figure. A good global tracker should be well under 0.5%. Then, there's the noise. Headlines about recessions, elections, or crash. My rule. If it doesn't change my 20-year plan, I ignore it. The market rewards patience, not panic. Stop refreshing your app and let the compounding do the heavy lifting. Let's look at the math. Imagine two investors, one who chases trends and trades daily, and one who follows this disciplined system. The first few years of the disciplined approach feel slow, almost boring, but around year 10, the curve bends. This is the hockey stick effect. You aren't just earning on your contributions anymore, you're earning growth on your growth. That is why the person who started investing badly but consistently 5 years ago is already miles ahead of the person waiting for the perfect moment to start. Wealth is built in the quiet years. So, that's the 2026 blueprint: foundations, tax wrappers, global diversification, automation, and extreme patience. Before you close this tab, I have a challenge for you. Don't just watch this, do something. Open your ISA or your broker app today and set up your automatic contribution, even if it's small. The habit is more important than the amount. Drop a comment below. What is the first step you are taking this week? I read every single one, and I want to see this community grow. Subscribe for the deep dive fund comparison coming next week, and let's build your ledger. See you in the next one.